Welcome to Optera's brief introduction to understanding emission scopes 1, 2, and 3. In order to impose structure upon the process of emissions accounting, the Greenhouse Gas Protocol divides emissions into three different groups called scopes. Understanding scopes isn't just necessary to comply with certain regulations and accurately build a greenhouse gas inventory. Understanding how your emissions fit into these three scopes presents insights and points to opportunities for decarbonization strategies. So let's discuss the three scopes. Scope 1 emissions refer to the emissions directly produced by sources controlled by an organization. Scope 2 emissions are indirect emissions from the purchase of electricity, steam, heat, and/or cooling. And Scope 3 refers to indirect emissions, specifically those resulting from assets not owned or controlled by the organization, but that the organization indirectly affects in their value chain. If those definitions seem a bit vague, don't worry, let's see some examples. Scope 1 emissions means that the emissions come directly from sources an organization owns or controls. This includes vehicles owned by the organization that run on fossil fuel. For instance, if an organization owns gasoline-fueled cars, forklifts, and ships, those emissions would be Scope 1. These examples of Scope 1 emissions resulting from vehicle sources are known as mobile combustion. And then there's also stationary combustion types of Scope 1 emissions. Think elements of a building, like an oil furnace or a gas-powered boiler. And there are also other sources of emissions arising from on-site landfills and wastewater treatment that are also included in Scope 1. And Scope 1 emissions also include what are called fugitive emissions, which refers to leaks from refrigeration, freezing, certain HVAC, and other systems using refrigerants, which are a powerful class of greenhouse gases. Scope 2 emissions are indirect emissions from the purchase of electricity, steam, heat, and/or cooling. Purchased electricity here recognizes that many organizations purchase electricity from the grid, which may be powered by emissions-producing processes, like burning natural gas. Scope 2 includes such emissions arising from the production of purchased electricity. Similarly, for organizations that purchase heating and cooling, like refrigeration and air conditioning, as well as steam, Scope 2 emissions reflects the emissions arising from their production. Scope 2 also includes fire suppression systems, if they're notable to the company, as well as the purchase and release of industrial gases. Which brings us to Scope 3, indirect emissions from assets not owned or controlled by the organization, but that the organization indirectly affects in their value chain. Scope 3 includes many categories, which we won't name here, but some examples include the emissions from transmission and distribution losses from electricity, business travel by employees and their commutes, emissions arising from an organization's supply chain, as well as contracted wastewater and solid waste services. When an organization is able to inventory its emissions, broken down by the three scopes, it will gain insights into the types and sources of those emissions. Multiple years of inventories can show trends and help prioritize emissions reduction activities. So remember, when conducting an inventory, an organization should consider the three emission scopes. Scope 1 includes direct emissions from a company's operations, such as stationary and mobile combustion from owned or leased assets. Scope 2 includes emissions arising from purchased electricity or steam heating or cooling. And Scope 3 represents indirect emissions from assets not owned or controlled by the organization, but that the organization indirectly affects in their value chain. This includes employee commutes, business travel, supply chain elements, and more. Thanks for watching.